Oil shock after Iran. How war could drive global energy and food prices.
Welcome to The Bigger Perspective.
The trading floor is unusually quiet. Screens glow with numbers that move faster than voices can explain them. Oil futures climb in sudden jumps. Analysts lean toward their monitors, recalculating projections they finished only hours earlier. Across the world, in ministries and command centers, briefings begin earlier than planned. Advisors speak in measured tones. Satellite images are reviewed. Maritime routes are quietly reconsidered. In the Persian Gulf, commercial tankers slow as shipping insurers reassess risk. Pilots receive updated instructions. Airspace corridors narrow. Meanwhile, in homes thousands of kilometers away, ordinary people watch the evening news. Fuel prices scroll across the screen. Grocery costs appear beneath them. The connection between distant conflict and daily life becomes suddenly visible. History shows that wars rarely remain confined to the battlefield. Their consequences move through markets, supply chains, and human expectations. The central question emerges quickly. If conflict involving Iran disrupts global energy flows, how far could the shock travel? And how deeply could it reshape the price of food, fuel, and stability across the world? Today's episode examines the potential economic pathways of such a crisis, separating what history teaches us from what remains uncertain. Iran occupies one of the most strategically sensitive positions in the global energy system. Roughly 1/5 of the world's traded oil moves through the Strait of Hormuz, the narrow maritime passage connecting the Persian Gulf to global markets. According to the US Energy Information Administration, around 20 million barrels of oil per day pass through this corridor, close to 20% of global petroleum consumption. That geography alone ensures that instability in the region reverberates far beyond it. Historically, energy markets have reacted sharply to geopolitical shocks. The 1973 oil embargo, triggered during the Arab-Israeli War, caused global oil prices to quadruple within months. A decade later, the 1979 Iranian Revolution again disrupted supply and doubled prices in a matter of weeks. Those events were not identical to modern conditions, but they demonstrate an enduring pattern. Energy markets react not only to physical shortages, but to expectations of risk. The strategic motivations surrounding Iran are complex. Tehran views its regional posture and deterrence capabilities as essential to national security, after decades of sanctions and confrontation. Meanwhile, the United States, Israel, and several regional states view Iranian military expansion and nuclear ambitions as destabilizing. These competing perspectives shape policy decisions. Some analysts argue that a limited conflict would likely be contained quickly, because all actors understand the economic consequences of prolonged disruption. Others counter that modern conflicts can escalate unintentionally, especially when multiple regional actors are involved. Both positions contain elements of truth. What remains clear is that the global economy today is deeply interconnected. Energy prices influence transportation, manufacturing, agriculture, and household budgets across continents. And when energy moves, food prices often follow. In the first scenario, tensions escalate into limited military confrontation but remain geographically contained. Initial strikes occur against strategic facilities or military assets. Governments issue firm statements while emphasizing that the conflict must remain limited. Diplomatic channels remain open, even if communication is indirect. Financial markets react immediately. Oil prices surge as traders price in uncertainty. Insurance premiums for tankers moving through the Gulf rise sharply. Some shipping companies temporarily reroute vessels or delay departures. Yet the physical flow of oil continues. Regional powers deploy naval patrols to secure shipping lanes, and international diplomatic pressure pushes for rapid de-escalation. Within weeks, markets begin to stabilize. Historically, energy markets have recovered relatively quickly from short disruptions. During the 2019 attack on Saudi Arabia's Abqaiq processing facility, roughly 5% of global oil supply was briefly interrupted, the largest sudden outage in modern history. Yet prices stabilized within weeks once production resumed. A controlled outcome would likely follow a similar pattern. Prices might spike temporarily, perhaps above previous highs. But strategic reserves held by major economies could be released to calm markets. The International Energy Agency maintains emergency stockpiles equivalent to roughly 90 days of imports among member countries. Even so, stabilization would not eliminate risk. The deeper uncertainty lies in how quickly confidence returns. Markets react not only to supply, but to expectations of future stability. And if confidence falters, temporary disruption can still ripple through global prices. The second scenario unfolds more gradually. Initial confrontation spreads beyond its intended boundaries. Regional actors feel compelled to respond, whether through direct involvement or proxy activity. Maritime security becomes increasingly fragile. Insurance costs for vessels moving through the Strait of Hormuz rise sharply. Some shipping companies withdraw altogether. Oil still exists, but the ability to move it safely becomes uncertain. Prices climb further. Energy markets operate on tight margins between supply and demand. A disruption of even 2 to 3 million barrels per day, only a small fraction of global production, can drive dramatic price swings if markets believe the shortage may persist. But energy is only the first ripple. Higher fuel costs raise transportation expenses across the global economy. Fertilizer production, which depends heavily on natural gas, becomes more expensive. Shipping prices increase. Farmers face rising costs for diesel, irrigation, and agricultural inputs. Food prices begin to rise months later. At this point, the ripple spreads from markets to households. In many developing economies, food already represents 30 to 50% of household spending. Even modest increases in global grain prices constrain family budgets and government subsidies. And here, the central uncertainty reappears. Could escalation be contained before reaching this point? Or could miscalculation push events further than any actor originally intended? History offers examples in both directions. The Iran-Iraq War of the 1980s included attacks on oil tankers, but never completely closed the Strait of Hormuz. Yet other conflicts, from World War I to more recent regional wars, demonstrate how quickly escalation can outrun expectations. This raises a critical question. When tensions rise in such a strategically vital corridor, who ultimately controls the pace of escalation? Beyond immediate market shocks lies a longer horizon. Even a temporary disruption could accelerate structural changes already underway in the global energy system. Major economies might move faster to diversify supply chains and reduce dependence on vulnerable shipping routes. Strategic petroleum reserves could be expanded. Investments in renewable energy, nuclear power, and domestic production might gain renewed urgency. In other words, the crisis could reinforce existing energy transitions. But structural shifts also carry geopolitical consequences. Energy exporters might seek new alliances and transportation corridors. Importing nations could pursue bilateral energy partnerships designed to bypass unstable regions. Naval presence in key maritime chokepoints could increase. History shows that energy crises often reshape global strategy. The 1970s oil shocks accelerated investment in North Sea production, reshaped Western energy policy, and prompted the creation of the International Energy Agency itself. A future crisis involving Iran could produce similar long-term adjustments. Yet such transitions unfold slowly. Infrastructure, investment cycles, and political agreements take years to build. Even determined governments cannot immediately replace the flows that currently move through critical maritime corridors. For that reason, structural change rarely eliminates vulnerability overnight. It merely redistributes it. Several realities are clear. Energy markets remain highly sensitive to disruptions in the Persian Gulf. Historical precedent shows that geopolitical shocks can produce rapid price spikes. It is also evident that modern economies are deeply interconnected. Energy prices influence transportation, agriculture, and inflation across the world. But uncertainty remains significant. We do not know how governments would respond in the early days of such a crisis. Strategic reserves could moderate price increases, or they might prove insufficient if disruption persisted. We cannot predict whether escalation would remain limited or expand through regional dynamics. Most importantly, leadership decisions matter. Moments of tension often hinge on restraint, communication, and the willingness of states to step back from confrontation. History shows both outcomes are possible. Conflicts begin with strategy. They begin with calculations of power, deterrence, and national interest. But their consequences travel along invisible pathways, through markets, supply chains, and the expectations of millions of people who never chose to participate. A tanker slowed in the Strait of Hormuz can influence a farmer deciding how much fertilizer to buy. A rise in fuel prices can reshape a family's grocery budget thousands of kilometers away. This is the paradox of the modern world. Local decisions produce global consequences. Energy routes connect continents, food systems cross oceans, financial markets transmit uncertainty at the speed of light. Which means that when tensions rise in a single maritime corridor, the effects rarely remain there. Conflicts may begin with force, but their consequences travel far beyond the battlefield.
What are your thoughts on today's analysis? We'd value your perspective. Share your insights respectfully in the comments below. Thoughtful discussion makes these conversations stronger. If you found this documentary informative and balanced, consider liking the video and subscribing for more in-depth global analysis. Until next time, thank you for watching.